This is 5 years of no BS futures options selling advice. Over the last 5 years, I have gone from blowing up 2 accounts and losing all my money to now consistently making $5,000 every single month by exclusively selling options on futures. I've also helped over 600 other options traders do the same thing, and now I'm going to walk you through it in this video. So in this video, I'm going to show you what a future and futures option is. I am then going to show you why futures options are greater than everything else because of the leverage, because of buying power, because of tax benefits, and so much more. Then I'll walk you through the 3 best futures option selling strategies, ones that I'm personally using to generate monthly income. I'll show you the back test, how to trade on the broker, everything you need to know about it so that you can walk away from this video knowing how to actually implement real strategies that work. And I'll show you how to mitigate futures options trading risk. Over these 5 years, I've made a lot of stupid mistakes and I've seen others do the same thing. And so I'm going to warn you about all those like basically roadblocks and how to get around them. And then I'll also show you a real case study of how right now I'm using futures options to consistently make $5,000 a month. So let's dive into the first thing is what is a future and what is futures options? So if I make my face small so I can keep the screen big, let's dive in here, okay? So a futures is basically a contract to buy another asset. So essentially we can think of a future in the simplest terms as a stock, okay? It's just something that we can buy and sell, all right? And now a futures option is betting on the futures contract, okay? So we're betting on what the futures will do. If you've ever done sports betting where you say, hey, I bet XYZ at football player, for example, will run 100 yards, then that's the same thing you're doing. You're betting on the player. And we're doing the same thing in the options, except we're betting on the futures. So for example, if we see a futures contract that's going up, then we can bet that it will continue to go up. And so we say, hey, I bet that the stock, or I should say this future, will stay above this level. And so as long as the stock goes up, goes sideways, or stays above the level that I picked, I'm going to make money because I'm betting that it will stay above this level. Now, again, we can do the same thing. Maybe the futures is a commodity because, again, futures are commodities as well, like maybe gold or natural gas or something like that. Let's say it's gold, which tends to be very neutral. We can know, hey, gold tends to go nowhere. So maybe I bet that it's going to stay between 2 levels. And I can do that as well. And so that means I'm betting it'll stay below this and above this. And if it stays between, I make money. And that's what options is. And as an options seller, all we're doing is betting on what the futures will do. And we're taking advantage of it by either betting the asset will continue higher, betting the asset will continue lower, or betting the asset will stay between 2 levels. And that's all option selling is, just betting on that and making sure the numbers work in our favor. And so now you may be wondering, what are these numbers I'm referring to? It is win rate by percentage. It is your win amount by dollars and your loss amount by dollars. We will talk about this with each strategy we bring up here soon, because as long as these numbers are in check, you can be a very profitable option seller, but you must know these numbers. So anyways, diving into the next section here, we already covered what are futures and what are futures options. I now want to explain why future options are greater and better than everything else. Okay, so if we're talking about other types of assets, it's pretty simple if we're just comparing it to a different asset. Why? Because let's say the stock is moving higher, right? If we were to buy a stock or buy a future, it's a 50-50 bet that we make money. Why? Because if we buy it here, either it goes up from here and we make money, or it goes down from here and we lose money. So with stock and options, we only have a 50-50% chance of making money. Either it goes up or it doesn't. Now, with futures options, or really option selling of any kind, if we, like, let's say, bet that it stays above this price, that means if it goes up, we make money. If it goes sideways, it makes money. If it goes down, we make money. We only lose money when it crashes dramatically below our level. And so as an option seller, this is a huge advantage, right? This immediately boosts our win rate from 50-50. Again, we're mentioning that win rate's a crucial part of these numbers that we're discussing. Goes from 50-50 to could be as much as 80-20, or even as much as 90-10. Or some of my trades even have a 95% win rate with a 5% chance of losing with my risk cap. So we'll be looking at that here in a second. But futures options and selling those gives us these really high win rates and the chance to put the odds in our favor. And so that's number one, why it's great. So one, we're put here, is it's great because of win rate. Number 2 is because of buying power usage, okay? Futures are an expensive asset, but yet the U.S. government wants us to trade it because they put in the tax code that we get certain tax advantages. We pay less taxes when we trade futures or do futures options. And so because they're incentivizing it, why shouldn't we do it and take advantage of this? Again, I'm jumping to 3 here, but we get tax advantages. And I jumped the gun here, but tax advantages are amazing because now we have 60/40 tax, okay? Typically, what happens here is that we have to pay basically a normal income tax on all of our profits. But when we're doing futures options, we only pay the normal income tax on 40% of the profits. And on 60%, we can pay a long-term tax, which in most cases is 50% or even as low as 0%. So we're basically paying nothing on 60% of our profits, and the other 40% we're paying the normal amount. So this is basically a way to cut down on your taxes dramatically. And like I said, the government wants us to trade this, and because it's so expensive, they give us buying power that allows us to do more with less. So we can have less money, but yet make more. And these are some of the advantages why futures options is awesome. We have a higher win rate. We get to make more money with less money. And the money we do make, we get to keep more of it because of the tax advantage. So those are some of the reasons why futures options are awesome. Now you know it. Now let's get into the details of this. Okay, let's talk about the 3 best futures options selling strategies, all right? So these are going to be some of the strategies that I'm actually using today. I have a back test for each, and then I'll show you how to plug it into the brokers so that you know exactly how to do it, okay? So number 1 we're going to be looking at is called a strangle strategy. This is a very great strategy. This is my go-to. This is the strategy that I've actually used to retire my wife because it's been so consistent. If we want to just look at the strategy here, just explain it, is let's say the market is going like this. We're essentially betting that the market stays below this level and above this level. So this is what a strangle is. It's betting that it stays between 2 levels. And so when we do this, if the market goes up, it stays below, we make money, goes down, it stays below, we make money. If it goes neutral, we make money. And the thing is, we don't even have to let this play out. We can then just let theta decay, which happens over time, aka we make money as time goes on, and we could just close that out early. And so typically we're only in the strangle trade for 17 days. Anyway, I'm getting too much into the weeds. When does this strategy work best? The strategy works best in slow bull markets. It works best in sideways markets, if you can understand my handwriting. And it works great in slow down markets. So these are our ideal markets that this works best in, all right? Now, let's break down the rules here. How exactly do we put on this trade? Okay, first off, we do this on a variety of assets. My favorite is ES. If you have a smaller account, you'll need to use a smaller asset like MES. I say this because a strangle on ES will cost you about $6,000 to $7,000 depending, and MES will cost you about $700 to $800, so depending on your account size. You can also do this with CL or GC, which is gold or something like that. So these are the assets that we traded on. Now, how do we trade it? We go between 90 to 120 days out. Again, I'll explain more in the risk management section here later in this video why we do this, but this is the ideal time. Next, how do I pick the levels that I'm betting on? For the bottom side, I'm picking a 10 delta, and so I'm picking a put delta. A delta put, should reverse that. And then for the call, I'm picking a delta call, so a 5 delta call, okay? Now you might be wondering, why are these numbers different? What do they mean? So 10 just means that I'm going a certain distance away, and 5 on the call side just means that I'm going further away. So the smaller the number, the further from the stock I'm going or further from the future I'm going. And because I trade this on ES and MES, which is the S&P 500, in general, that asset tends to have an upward drift. It tends to trend higher. And because of that, I want to give myself less downside room and more upside room so that I can account for the movement up and it won't break my level. And so that's why I do it that way. Now, I manage this trade by a 25% take profit. So once I have a 25% profit, I then close the trade, and I manage it by a 300% stop loss to help mitigate losses in addition to other things I do, which I'll discuss in the risk management section. So this is how the trade is structured. Let me show you a back test, and then I'll show you how to do it on the broker. Okay. Here is the back test for this. You can see here that we're selling a put. Again, this is 16 delta, 5 delta. I meant to change this, but I do 10 delta, 5 delta, which makes the win rate a bit higher. But anyways, you can see here we're doing a 97% win rate on this trade. We have a 25% take profit, a 300% stop loss, and it's a very consistent strategy. You can see here how well it's running, how well it's doing, and this is my go-to strategy that I'm doing. As you can see here, it just performs very well. Now, in down trading markets, obviously it's going to struggle. It's going to have some losses. There are things we could do to offset those losses and prepare for them accordingly, but we'll discuss that later in the risk management section. but this is one of my favorite strategies. And so if we're wondering how to place it on the broker, again, you can see here, this is the strategy that I'm running. And so far today, it's made me almost $600 just running this strangle strategy. So that's awesome. But let's dive in here. So how do we do it? We go to the broker, make sure we're trading ES or whatever futures asset you want to do. Again, remember, we're going between 90 to 120 days. So let's just do 90 for this example. Then again, we want to make sure on the right side, which is the put side, we're looking at delta. And so on this delta, we want to make sure that we select 10 delta. So again, I'm going to sell the 10 delta here. Whoops. Sometimes I need to reload. Sorry about that. Okay, so now I should be able to sell the 10 delta. Click on that. Perfect. Now on the put side, the call side, which is on the left side, we're going to look for a 5 delta level. So 5 delta here, I'm going to sell this one. So just like that, sell the 10 delta put, sell the 5 delta call. Right here, you can see a $2,000 max profit. That's awesome. But again, we're not going to collect the whole 2,000 because we do a 25% take profit, which is you have to multiply it by 0.25. That gives us a $500 profit. So that means for this trade, we're looking at a $500 profit, which is insane because how much money are we putting up? We're putting up about $6,500. So I put up $6,500 and I make $500 back. That's about a 7.6 or 7.7% return on my money in a matter of 2 weeks. Do you guys get that? I get to make basically 7% return every 2 weeks. Now, if I lose, though, I will have a decent loss being of around $6,000 because it's this amount times 3. And so again, that's what we're looking at, but the numbers play out very well, especially when we look at the back test. You can see here a 97% win rate. So yes, I have larger losses compared to my winners, but when you look at it overall, it tends to perform there. And so that's how you structure the trade on the broker. You would just place it and then manage it from there based on 25% take profit and 300% stop loss. So this is strategy numero uno. Now, strategy number 2, this is one that I actively use as well. This is a 1-1-1 strategy. Now, if you're unfamiliar with this, that's completely fine. It's not a super popular strategy, but it still works very well. So how does this one work? Okay, let me first say this one works best in bullish markets and sideways markets. And this is because there is no upside cap. Like the strangles, there is an upside cap that we don't want to break. This one, it doesn't matter. You can go as high as it wants. Okay, so just to show you what this looks like, if we're trading like this, we're betting that the stock stays above this level. So as long as the stock goes up, we make money, goes down, we make money, goes sideways, we make money. But the thing is, there's also an additional hedge here built in. So if the market goes down, but still stays above our level, then we get a 2x payout. So we get our normal payout here, which is however much we make, which we'll see here in a second. But then if it comes into our max zone, we'll make 2 times that profit. And then of course, if it breaks our level, that's when we start losing money, all right? So this is the 1-1-1 strategy. It's a very great and consistent strategy. So what are the rules for it? Again, we're doing the same assets, so ES or MES, depending on how you want to trade it. You can also do this on CL or GC when you see it trending up, because again, this works best in bullish markets. Again, we're doing the same DTE, 90 to 120 DTE. I'll explain why about this again on the risk management section here after the third strategy. How we trade this is we buy, so +1, we buy a put that is a 25 delta. Then we sell a put at the 23 delta. This is best practice and how I trade it. And then what we do is we sell a put at 10 delta. So what does this do? Selling this one put is what makes us or allows us to make money when the market goes up by betting on this level. And this is what creates the hedge that allows us to make money and offset our losses when the market starts to go against us. How do we manage this trade? I personally manage this trade at 50%. I close out the entire trade. That's a 50% take profit. And then I have a stop loss of 21 DTE. Now, if you want to have a real stop loss on this, you could also do a 300% stop loss, and that will close to simulate it as well. So this is how the trade is structured. Now, if we're looking at the back test of this trade, this is the 1-1-1 buy. You can see we buy the 25 delta. We sell one that's about $25 away at the 120 DTE mark. And then we also sell a 10 delta. We have a take profit of 50%, and then we close the trade when there's 21 days left. Again, if you want a real stop loss, you can do that as well. Now, what I love about this strategy is although it's an 83% win rate, not as high as the strangle, you can see here our average winner and average loser is very close. They're very similar. So you can see here on average, we'll make about $1,000 per trade depending. And then our average loser will be about 1,500. So that means when we lose, it's going to roughly equal a winner. So it's not going to hurt us as dramatically as the strangle strategy that I just showed you. You can see here, very consistent, works well except for downtrending markets, as mentioned, best for bullish markets and neutral markets. And so that's what we're seeing here, but still a very consistent, very great strategy that a lot of my members are using as well. And so that's a great strategy. Now, how exactly do we trade this on the broker? This is a 120-day trade, so we'll find the closest to 120. You can see here one of my strangles going on. Anyways, if we're doing it, we're gonna buy the 25 delta, sell the 23 delta, and then we're gonna sell the 10 delta. Okay, so right here. So what are we looking at for this trade? Okay, so this trade is roughly going to cost me $3,000, so a lot less buying power, which is very nice. But what's also going to happen here is we get two types of payoffs. Like I said, we get to make money if the market stays where it is or goes higher, but if it goes down, we have the potential of making more. As you can see here, this is our 1x payment, which means that if the trade just stays normal or goes higher, we'll make $1,500, $1,563. But now in that 2x payoff, we'll make about $4,000 if we get into that hedging range. Now, again, typically I close these trades at about a 50% profit. So if we have a normal profit of $1,550 and I want to multiply that by my 50% profit, that means I'm going to make about $700 per trade on this. Now, this isn't saying is my return on buying power. I'm going to make $700 from this trade, but I'm only putting up $2,600. This means I'm making almost a 30% return on my money. Now, guys, I do have a lot of risk on this trade, right? So like I'm making and losing about the same amount, but you can see here, $1,500 is the amount of money that I'm making. So if I do a 300% stop loss, 3 times that, I'm going to be losing about $4,500 per trade. That's something to keep in mind, but still, this is a 30% return on your money in a matter of about 3 weeks. Again, this trade takes about 3 weeks, but still, right? That's an insane amount of money. And so that's what I love is you can make a 30% return on a monthly basis by putting your money in this. Now, there's a lot to understand from risk management, so don't just jump into this blindly. Make sure you stay and watch the risk management lesson, but this is a very great strategy as well. And so that is the 111 strategy and how it's structured. And last but not least, we have number 3. These are for my people who enjoyed the 111, which I have a lot of members who've made a lot of good money from the 111 strategy. But for people who want to be a bit more risky, who want to add to that risk, it's a 112. Okay. Everything here works the same as the 111, except instead of here, the structure looks like we're going to buy one put at 25, and then we're going to sell one put at 23, and then we're going to sell 2 puts at 7. Okay. Ideally, you go between 5 and 7 here, but I personally like to go 7. Again, the higher the number, the more profit you make, but the lower your win rate. The lower number here means the higher your win rate, but the less money you make. And so this is the structure for that. And this one's managed a bit differently. This one's managed at a 90% take profit because you typically turn it into a hedge after. So you can hedge this trade, which is a great way because it has a lot of risk to it. And then again, you typically manage it at 300% stop loss as well. So this is that trade. So again, if you want to see the backtest for it, it's right here. Obviously, it does insanely well. You can see here over the last, what is this, from 2013 to 2024, so about 11 years, it's made $1.2 million, which is insane, which is really cool. But anyways, you can see here that the average winner and the average loser is about a 3x difference. So unlike the 111, you have a lot more risk concentrated here. It does take about 60 days for this trade to hit its take profit because we're looking for roughly an 80 to 90% take profit. And then again, the stop loss there as well is leading to those losses. Anyway, so still have about an 86% win rate, so not too bad. I've had a lot of members make good money on this, but also lose a lot of money if you don't manage risk correctly, which is something that must be done with a 112, all options trading, all trading in general, but especially with a 112 is the amount of risk. So let me show you exactly what I mean here. So if we're looking at the strategy here, it's roughly exactly this, but we move our short put. So we buy the 25 delta, we sell the 23 delta, and then we sell the 7 delta, except we're going to click on this and we're going to sell 2 of them. So now we sell 2. So now you can see here, We maintain roughly the same win rate, a 97% win rate. We basically double the amount of buying power money it takes for us to put on this trade, because we're basically doing 2 of the naked puts. But we also increase our win rate by about $1,000. You can see here, we were going to make 1,500, but now we're going to make 2,500 if the market does nothing. And if the market goes into our little bear trap, where we make more on the hedge, then we'll make about 5,000, which is cool. So this is a great strategy. It does require a larger account. I would say about $100,000 plus, and you need to manage risk like very strictly. But overall, this is a great strategy as well. If you're a beginner looking for something small, again, stick to the 111 and the strangle. If you have a smaller account, do it on MES. If you have a larger account, do it on ES. If you're looking to diversify, you can go against CL and GC. So these are the 3 best strategies that I have found and that I use to make money as a futures options seller. Now you can actually go and deploy that right now, since you know how they work and how to manage them. Cool. Let's get to the next section, which is very important with futures options because of the amount of leverage we have, is how to mitigate futures options risk, how to decrease our risk. And so if we're looking into this, there's a few ways to do this, but the first thing we need to identify is what is the risk do we have as a futures options trader. And so if we're looking at it from that perspective, our risk, we have a couple. Number one is buying power risk. Okay, we have buying power risk. Why is this? When you're using buying power, and say using margin with stock and stock options, mainly stocks, because we don't really get to allow to use marginal stock options. But anyways, when you're using that, typically whatever it says, the amount of money it takes is the same across the board. If you enter an option and it says that it costs you $700 for that option, then throughout the lifetime of being in that trade, it will cost you $700. Now, buying power for futures are different. The buying power is based on the risk in the market. Let's say I enter a trade. At 700, where it takes $700 for me to put on this trade. But if the risk goes up, so does the buying power. So before I only needed 700, but it could jump up to, let's say, 1,100 for this trade. Now I need to make sure I have at least $1,100 in my account to cover this same trade. So buying power can fluctuate. And because of that, you need to have a decent amount of money set aside to handle these fluctuations. And that is where the 30% risk type of rule comes in. So what does this mean? It means that if we're trading futures options, we should have no more than 30% of our money inside of a trading account. This means if we have $100,000, we should not be trading with more than $30,000. Why is this? Because we need a significant portion of our money in cash available for the buying power change. If the market were to crash, all our trades would require a lot more money from us, and we don't want those trades to close because they'll close as losers. We want to hold on to them so we can see the trade out. We need to have plenty of cash set aside. And so now you may be saying, okay, Austin, the 30% rule is a good way to limit our risk, but what about my returns? Like I mentioned, guys, when we're doing futures options, we get insane returns. We're talking like 10 to 30% a month, depending on the strategy you do. So if you do a 10 to 30% return, but you're only using 30% of your account, you're still making a good return, right? So if I am making, let's just say for number's sake, I am making a 33% return on my money per month, and I'm only using 30% of my account, that means my overall account is growing by 1% a month, right? So that's the power of it. Actually, I'll take that back. My whole account is growing by 10% a month. Yeah, so let's actually make the number smaller, right? Sorry, I don't do mental math in my head first on camera, but so let's say I'm making a 10% return on my money every month, but I'm only using 30% of my account. Then I'm making a total account growth of 3%. And if I do that every single month, 3% of my overall account, then by the end of the year, I made a 36% return. And that's insane because I only need to use 30% of my money. So there's buying power risk, and the way to undo it is by trading with no more than 30% of your account. Okay. Number 2 is volatility risk, which is known as VIX. This measures the volatility in the market. As option sellers, if volatility goes up, we then start losing money. Okay. So when volatility is low and moves higher, we lose money. When volatility is high and moves lower, we make money. So where's the risk? Risk is when volatility is at a cheap price because it's at a higher chance of moving up, right? Volatility risk is very high when the market is lower. So what we can do is we can control our risk and control how much we're trading with depending on where VIX is. If VIX is less than or under $15, then instead of using 30% of our accounts, because this is a high risk time, we can maybe use 15% of our account or something like that. This way, we don't have all our funds allocated into the market when we're at the highest point of risk, but we still have money deployed so that we can make money. And then when VIX increases, meaning that we have less risk in the market, so let's say above 15 or maybe above 30, wherever you want to set that, then maybe we can go with our full 30% of our account worth, okay? There is volatility risk that will impact us, and one way to get rid of it is by basing our trading size and how much money we're using based on where VIX is. Another way to do that is to use longer DTEs. Now you may be like, what the heck is this? When you go out further in time, you have more time for the trade to work out in your favor, so you're less impacted by the volatility of the market. And other side effects of a long-term DTE is you increase your win rate because strike prices are further out and you have more time. You also increase the amount of credit you collect because there's more theta decay available. And like I mentioned, we eliminate volatility risk. We don't eliminate it, but we decrease it a lot. And so again, volatility risk is something we need to keep in mind. And we can do that by changing our trading size based on where VIX is and doing longer DTEs, which is why all these trades are 90 to 120 DTE. 3, we have market risk. And so market risk is where the market crashes, right? Because the market crashes, then we'll have a lot of issues, aka we'll have a lot of losses, especially if we're very put heavy or we're selling a lot of puts, which is what a 111 or a 112 is. It's very put heavy. So market risk. And we can solve this by using an indicator to determine when the market is overextended and getting out, or limiting our trading when the market is overextended and likely to pull back. Or we can define trends and only trade with the trends. This is trend trading. So if you ever looked at a chart like that and use trend trading, that's what you're doing. So there's market risk. And in order to account for that, we can only trade the strategy when it's in the market that best works for it. We can also use indicators to give us heads up of potential market crashes. So those are the 3 common risks and way to offset that risk. But guys, reminder, be very careful. Selling options on futures gives us huge returns, but there's also a lot of risk, especially with the buying power risk and volatility. And so if you don't keep that in check, you can easily blow up your account, and I don't want you to do that. Well, with great power comes great responsibility, as said in every Spider-Man ever, although Tobey Maguire is the best one. I'll fight on that one. But anyways, this is what to know about risk when trading futures options. Now let's get to probably something you guys are interested in, is how do I personally use futures options to make $5,000 per month? Okay, there are a lot of ways to do this. Like I said, I use these 2 main strategies, which is my strangle strategy and the 111 strategy. These are my go-to. Most of my money is in the strangle. The other one of my money is in the 111 trade. Again, I trade with no more than 30% of my account, but the way I do it is something special, because as we all know, when we're trading, there's emotions involved. Either I tend to overtrade my account and get in more trades than I should, which can crush you as a futures options seller. You can also let emotions get in your way so that you don't get in trades at the right time, or maybe you chase them and it just doesn't work out well. Or maybe you're just busy, right? You're trying to spend time with family, you're trying to retire, you're trying to enjoy life with your wife, with your kids, whatever. You're trying to be focused at work, you just don't have enough time. And that's why I use automation to make this happen. Now, there's a lot of great options automation tools out there, but my favorite is the Options Auto Trader. So you can see right here, the Options Auto Trader is great because it's the only options automation platform that supports futures options selling. So if you want to sell and automate your futures options selling, it can only be done on this platform. And it's also super easy to do. So let me show you. All right. You can see here's an account I just started with this year. You can see I literally started this account for my strangle strategy. I started it at the beginning of this year, so literally 3 weeks ago, and it's already making me $1,200 in a matter of 3 weeks, which is awesome. You can see here the trades; it's all being watched, all being managed. Again, you can actually see these trades in my Tastytrade account because they're actually connected here, and so that's how awesome it is. Now, let me show you how to set this up for yourself because it's super simple. All right. First, you connect your broker. So once you connect your broker, the system will be able to automate trades through it. So once we connect our broker, which my Tastytrade is connected here, then I just click on Create Auto Trader. So I just basically create the bot for this system to follow. And so I'll click on Create Auto Trader. And again, I can pick any strategy I want. So if you have another strategy you want to automate, you can do that as well. But for this instance, we're talking about strangles because that's my favorite. Then I can pick what futures options asset I want to do. So again, ES is one of my favorites. And then again, this is a 90 DTE strangle. Remember, I do a 10 delta. I sell the 10 delta, and then I sell the 5 delta call. So I just plug in how I want my strikes picked. Next, I define how often I want to enter into the trade for myself. I enter every single Tuesday and Thursday. So that's my entry cadence because I have a larger account, so I can do that. So Tuesday and Thursday there. And that's how I run that strategy. Next, like I mentioned, I manage my profit at 25%. So I put in 25 to manage 25%, and I have a 300% stop loss. So just like that's how this trade is managed. I save and continue, and that saves it. Then I define how much money I want this bot to trade with. Remember the 30% rule. So if I have about $100,000 in this account, then I could use $30,000 for this bot to run efficiently. And so now you may be saying, Austin, but didn't you say there's safeguards and risks that we need to be aware of? Yes, of course. And that's why they're built in here. So for instance, I can enable VIX-based buying power, and this changes how much allocation my bot is using, how many trades my bot is in based on where VIX is. If VIX is higher, I get to use all my money because it's less risk for me. If VIX is lower, I only have to use 15,000 because the market's at higher risk, so I'm going to be in less trades, okay? So just like that, enabled that, it now eliminates most of my volatility risk. Now, market crash risk, there's an indicator built in that helps me understand when the market is at a high level for a crash, and I can click enable, and now the market will get me out and start scaling out my positions when the likelihood of a crash is higher than normal. So just like that, I can define that and eliminate the volatility risk, the market crash risk, and again, by sizing the bot correctly, I also helped with the buying power risk. So just like that, here is a bot that will, through my broker, based on the rules that I've set here, will automate my futures options selling strategy for strangles. It'll also manage all the risk, and it will make sure that I cut out the learning curve and just get to the profit part, which is awesome. And so just like that, you can see here, mine's been running for about 3 weeks, about $1,200. Again, I have a lot of other accounts connected from my Schwab account, my TradeStation account, and all that stuff. And it works great. So anyways, if you guys are interested in automating your trading to get to the next level of freedom, but also having the income as well, then you can click the first link down in the description to start your 30-day trial. Anyways, that is everything I have on futures options selling advice, from buying power to account sizing to different assets and the best strategies. I hope you learned something, and if you did, smash that subscribe button. If you want to automate, then click on that first link down below. All right, see you guys.